Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up for this Wednesday, the 23rd of October, 2019. And right now, we're sitting at a time frame just after 4:30 p.m. Central Daylight Time. After-market earnings, Tesla blowout. Profit. Can you believe it? A profit. Traders are still looking for about 45 cents a share in loss, and I think they got like $1.90 in profit if I'm reading it right. And Tesla's putting forward very good forward guidance, so a surprise there. Microsoft did fine. Ford, yeah. But what I'm making a point of is earnings season. So we do this each time. Boeing, all these other companies come in. But the stock market withstood it. And in fact, you closed up today 11 points in the S&P, 39 higher in the Dow, 42 in the NASDAQ. And as I said, after market, Tesla being up will probably kick some of these even higher. Metals were higher as well, as were a number of currencies, but it's an interesting time frame. First off, tomorrow I think we get the European Central Bank meeting. That is something we have to keep our eye on. I think it's going to be more fanfare for Mario Draghi, as this is his last time that he'll be the president of the European Central Bank presiding over a monetary policy meeting, as Miss Lagarde comes in on Halloween. Sounds scary, but that's just how they pick the date. You were up today in the energies, a solid performance there. And the reason is the EIA numbers today came out whopping. Very big declines across the board. Market was not looking for anything like this. It really blew out the API numbers of yesterday. Bonds and notes, just stable as they're sitting here right now. You're not getting that level of short covering that I've been expecting in the market in front of these central bank meetings. We'll see what goes on with them. When we take a look at a weekly area chart of closes, just the closing price of the S&P, the market today finished 30.0570. We still have not been able to get over prior highs in these markets. We keep making lunges, if you will, a surge towards them, and then we get these pullbacks. The market's been contracting. We'll see if it can break out of here one way or the other. When we take a look at this chart, you can see you have congestion here and here. As I said, you have to use your imagination, but some might say this is a head, a shoulder, developing another shoulder, and I would say that if you closed over 30.30, what will happen is those people that are doubting Thomas's, you'll start reading in the news. You know, that looks a little bit like an inverted head and shoulder. Another person came into the office today running after a chart and wanted my analysis of Intel. And they're trying to tell me, well, it's a cup. And I'm going, you guys got to understand, all these formations are wonderful. People put names on them. I'm more interested in moving averages, slow stochastics, numbers I can relate to in a different way. So the point that I'm making here is we're in a consolidation zone. When you put on the swing line number, you have a pattern of a higher high and a lower low. That is not a trend. You've got a market that's just whipping around here looking for its own guidance. The market tomorrow could put in the pattern of higher lows, higher highs by simply having an inside trading day or taking out today's high. That's all it will require. The one thing you don't want to do is take out today's low. If that does not occur, I'll have higher highs, higher lows, but obviously you know I'm looking at this resistance area that I could extend all the way back here as well. So I know we're in an area of resistance. That doesn't mean anything's bearish just yet. When we take a look at where the market's at in relation to moving averages, you have what's called a classic bull market setup. You've got the 18-day moving average over the 100 over the 200. That is considered a bull market setup on moving averages. Where's the resistance? It's slightly above the market into those highs of 30, 36, 60. So let's call it 30, 36.50 just to round it up. That would be the resistance point. Obviously, you've got to get over these other highs to get up there. And in terms of momentum, you have an embedded slow stochastic trade, which tells me that on pullbacks, such as you had today, the pros will be out there nibbling away on the long side to see if the market can get any legs so that it gets away from that pattern of a higher high and a lower low. This rules the day when it's embedded. You have it embedded until the red line closes back under 80. 80, I say the bulls are in control of the market. The bias is up. What's been lacking is getting the swing line higher high, higher low. You have a setup for it. Let's see if it can work with it. When we come to the NASDAQ, we've had the opposite. Well, first, let's take a look at momentum here. One of the numbers is under 80. You don't have an embedded reading. So end of that discussion. The market's in the thrall of trying to get down to that 18-day average of closes. Today's low is 78.10. The 18-day average 78.0150. In the process, you have a pattern of a lower high, lower low in the market. So now we have to say to ourselves, okay, we have momentum trying to point down. Was it ever embedded? Let's take a look. Today we know both numbers were what? One of the numbers is under 80. But yesterday, Tuesday, both numbers over 80. The day before over 80. The day before over 80. The day before. So the one thing I teach you is this. When you lose an embedded reading, the only time you can get it back without going through the whole rebuilding process, which takes a bit of time, is the day after it's lost, will the market regain it? Now, the fact that this market came back and settled near the highs of the day, when it reopens tonight, will be very, very important. That could be where it gets rejected. Now, if it's rejected, it means that the test of the 18-day average likely occurred. It's already past us at that point. That was it. And now the question is, can the market negate the bearish trend here and make a run for that upper Bollinger Band? That's how I'm thinking in the market. Doesn't mean I'm right. That's my thought process. When I come to the Dow, you've had a pattern of lower highs, lower lows. Now, today's low in the market was 26,588. The 18-day average, 26,613. You went to it, you turned away, and you finished at 26,802. So often I'll tell you, when you get to that 18-day average, the market tries to figure out what to do. What's important is, like the NASDAQ, now, you still have a lower low and a higher high pattern. Even if you take out 26,904, you will not turn that pattern up, and you're in an overbought condition. Certainly not one of my favorite indices on this chart pattern. In the Russell, I see an overbought market that on the first challenge of the upper Bollinger Band got thrown back, but the trend is up. You have higher lows, higher highs. As I said yesterday, you have two levels of support. What I'm not in favor of is the overbought condition of the market. You have both numbers today over the 80 level. Yesterday they were both over 80, not the day before. Takes 3 days in a row to embed. So your most overbought status, it could embed. If it does, the odds favor another challenge of the upper Bollinger Band. If it doesn't try to embed and turns down, the question is, what does it do with these support levels that are below it? In the VIX, we're seeing the market move back to the upside, not giving that opportunity to get, for the pros, writing some puts down here, resistance, two levels. The 100-day average and the 18-day, you have the swing line up. The bias is down since you're under the 18-day average of closes, and you have a bearish embedded reading, which means the pros are likely selling this market until you get the red line closing over 80. In the T-bond market, a nice rally today, got up to 160.22, but you didn't take out a previous high. You actually failed against it. That's 160.22, as you can see right over my shoulder. Came back to it and just sort of hung here. What about the slow stochastics? Are they embedded? Embedded means they've locked in a bear trend. So both numbers today are under 20, as you see. Both yesterday were under 20. Both under 20 the day before, not the day before. It takes 3 days. You have an embedded reading. What will trigger in my head the fact that the market wants to get a short covering rally in front of the next FOMC meeting, which is the 30th and 31st, I believe, getting the red line over 20. Until that occurs, the bears control this market. Now, what you did get down and tried to run into the 100-day average and turned away from is there. But going home, the bears control this market. The bears still control the 10-year notes. You've got the lower highs, lower lows, no change there. What about the embedded reading? Well, both numbers under 20 today, both under 20 yesterday and the day before. So just like in the bond market, if the red line gets over 20, it tells me a short covering rally is about to ensue or ensuing. But until then, the bears are controlling this, and they're going to try to limit those gains. In TLT, we have the pattern of lower highs, lower lows. Now, today's high of 140.31 did not take out the previous high. You have the embedded reading, so everything's together. If they all lose the reading, you'll probably see that in the slow stochastics getting lost. Don't play for it. If it happens, it happens. There's nothing bullish on these charts. That's the point. In the dollar index, you have the bearish embedded reading. That means to me that on these rallies, the pros are sellers of this market. They're looking for lower prices until that red line closes over 20. It gives you room between the 100-day average and the 18, but I don't know. This market's stalling already. It had great trouble at that 100-day average. I'm bearish that market. In the eurocurrency, well, now I get flip-flopped a little. If we take a look at yesterday's reading, both numbers over 20, both over 20, both over 20. Not the day before. You lost that reading today with the reading of 79.26. Tomorrow's key. Will the market try to regain it, or is the market saying, no, I'm ready to get a bit of a correction here? Well, the euro's in its own little world here because the European Central Bank meets tomorrow, and obviously you've had a heck of a run to the upside. Maybe some pros are just taking money off the table. I'd be cautious. I see nothing to break the uptrend, but this is a warning sign that a correction could set in right now. If it regains the embedded reading, you're putting into play these numbers. If it keeps it lost tomorrow, the odds favor price and the 18-day average try to make a run at each other. Do you want to play the European Central Bank meeting? I don't. You're going to wake up and then you're going to know what's going on. Not my cup of tea. In the British pound, again, nobody's cup of tea. The danger here is we don't know what the European Union is going to do. Boris Johnson, that's the Prime Minister of the UK, is putting his pressure on the European Union. He had a right under the BEN Act, it's called BENN, a letter requesting that if they could not reach in Parliament yesterday, that was the key day, that the UK asked for an extension. Now, what time frame is the key? They could go to January 31st. They can go a shorter time. Mr. Johnson has put on the table that if they go to January 31st, the odds favor that by Christmas he's going to have called for a general election. That throws everything again into disarray. What he's not understanding is the EU has nothing to lose. They're better off. First of all, the UK's paying them while they're in there. Second, they prefer they stay in there. So they're not his enemy or his friend. They're not going to upset the cart. So we'll see what they do tomorrow. But that makes this whole game so difficult to play. You have the embedded reading. You have a bullish chart, a vertical price rise. There's nothing I see here yet that's bearish. It can come out of left field. Then we get to the Japanese yen. Once I see embedded readings, I say that these rallies, and I realize it's been a contra-trend rally, this still rules the day. And I think the pros are selling this. If they can get it under 92.22 and a half roughly, they could get this market going for the lower Bollinger Band. The bears control this market until you lose that reading. Bitcoin, I don't know if you saw Mark Zuckerberg, he was talking today in front of Congress about Libra. And as he's talking, I'm watching this market tank, because he made it very clear. Without getting regulator approval, that Libra idea is going nowhere. And of course, these senators, they're against social media. I'm saying senators, Congress people, let's call it that. They're against some of the strong influence that social media networks have. So you were looking at that going on, but all I care about is the Bitcoin, because that's what we're talking here. And you could see how you broke under the Bollinger Band. You were going sideways. The question is the first challenge, which you got to today. I'll repeat what I say so often. I wish I could go further back. There's not enough data. When you get to the 18-day average of closes, think of that as the line in the sand. When you get there, it's also like a pinball machine. If you'd hit a Bollinger Band before, that does not mean if you fall again, it's not support again. It is. It's a reset. So we're not running the lower Bollinger Band yet. We hit it, and I think pros took some money off the table. Now the question is, does it have legs to the downside? In crude, notice how the differential between Brent and WI keeps narrowing in. And we saw today a big rally happening. We saw first in the Brent, the market get up to the 100 and the upper Bollinger Band. Now, if I come back here, you hadn't hit those, so you got up to them today. Good day for this market. Will it be able to stay over? That's a question. It's overbought. I have my doubts. The trend is up. It hit its upside targets. I am not bearish. Do not take that wrong. You're into a key resistance, and each time we've hit that combination within a short period of time, the market seems to back off. The same thing happened in WTI, and the reason this market got so strong today, if you saw the EIA numbers, and I wrote about them in my daily updates today, powerful numbers. I mean, in every category. Increased refinery capacity, big draw on distillates, gasoline down, and a big one on crude oil stocks. So everything down, trend up, into a objective zone. Be careful of pullbacks here. Gasoline, same thing. The market's been staying over and been successfully testing the combination. When I say successfully, coming down to it, but holding these numbers. And today it broke again out to the upside. Uptrend, overbought into a key resistance area. And in that gas, still bearish. I'm a little nervous here because the first cold weather that comes in, this market has a tendency at this time of the year to pay attention. The trend is down. These are the downside targets. Momentum down. Nothing bullish on this chart just yet at all. So don't go bottom picking, I guess is the way that I should say it. So when I look at it, the boards have now cleared behind me, but I haven't cleared. You know, I'm starting these special reports on my videos, and as I told you, I'm now ready to rock and roll. I spent the afternoon looking at different charts. What's my next report going to be on? Let me tell you how these reports work. Right now, they're free, but after 3 views in any 52-week rolling period, if you're not a subscriber of ours, to my research in some manner, it could be these videos, other things that you want, not on YouTube, but I'm talking my subscriber video or have a trading account with us. After 3 views, you're going to find that this becomes a pay-for-view area. Why? Because we get a massive amount of people that want to look at them. And for me to support the research myself, I don't think there's anything wrong with you having one of our subscriptions or having an account with us. If not, I guess I'm not that important on your information. But what I do in these reports, and I did it in the silver report that I put out, I'm going to put out what the 5, 15, and 30-year historical patterns are when I'm writing that report. I'm going to go often to a longer-term chart. In this case of silver, I did both a quarterly and a monthly report. Then I went to the weekly and the daily because we're in a very important area in the silver market right now, and the question is, what has to be held if the market's going to go up, or what has to be broken if it goes down. You have to read my report, or actually you can't read it, you view it. It's all a video. It's so much easier to do video and so much more fun for me because you can stall if you want, hit pause on the video. You can look at the charts really well. You see what's going on, and I don't have to worry about these small little charts that sometimes you need a magnifying glass to read. How do you view it? Go to www.iraepstein.com. Under the word research, as soon as you get up there, put your clicker on it and you'll see drops down, you'll see the metals report, enjoy it. Up here, if you watch this icon, just click on it, it'll take you right to that page. This report's only up 5 business days. I published it on Monday, so time's going to run out for you. And the reason for that is these reports are meant to be timely. They're for now. They're not for history down the road. I'm Ira Epstein. You have a great day, and I'll see you all tomorrow.